Well, if you're looking at the global markets right now in April 2026, you know that the word chaotic barely even begins to scratch the surface. Welcome to The Explainer. We are operating in a reality where consensus-based valuation and traditional synergy modeling have become, frankly, structurally unreliable. Those pre-war baselines, yeah, they're practically obsolete. So today, we're going to untangle exactly why that is and, more importantly, how to actually navigate it.
Our blueprint for today is the April 2026 SVELTE Report by New Corporate Management. This is an absolutely vital piece of geopolitical and economic intelligence. Our goal right now is to translate its assessment of this high-entropy environment into actionable strategy for you. We aren't just looking at the problems here, we are looking at exactly how the boardroom needs to restructure its thinking to survive them. So here's our roadmap. We'll start with the 2026 high-entropy crisis, move into the dual shocks of energy and trade, look at the Fed leadership discontinuity, Europe's binary funding cliff, the AI valuation trap, and finally, M&A strategy and earnings.
All right, diving right into Section 1, the 2026 high-entropy crisis.
Just look at how rapidly these events have compounded. On February 28th, a kinetic military campaign kicked off, which led directly to the partial closure of the Strait of Hormuz. Less than 2 weeks later, on March 11th, the U.S. Trade Representative initiated fresh Section 301 investigations against China. Fast forward to April 24th, and Brent crude spiked above $106 a barrel. And looking just ahead to May 15th, we are staring down a major Federal Reserve transition right alongside a massive fiscal funding cliff in Ukraine. You see, this isn't just a series of isolated events. It's a rapid, chronological cascade where a kinetic event in the Middle East directly bleeds into trade escalations and monetary policy shifts.
That brings us to Section 2, the dual shocks of energy and trade.
The contrast here is staggering, and it's hitting from both sides. On the energy side, the Strait of Hormuz closure has essentially wiped out about 10 million barrels per day from global supply. The World Bank is literally calling this the largest oil supply disruption on record. As a result, we're seeing Brent crude fluctuating wildly, anywhere between $96 and $120 a barrel. Then, on the trade side, we've got average U.S. tariffs on Chinese goods hitting a crushing 47.5%, and that covers 100% of Chinese exports to the U.S. Plus, there are threats of an additional 50% tariff hanging over us, entirely contingent on geopolitical alignments.
Which leads right into a critical takeaway from the SVELTE report. It states that the interaction between the tariff regime and the energy shock creates a dual-cost shock for multinational supply chains. Think about what that means for a second. If you're still relying on your 2024 synergy models to justify some logistics acquisition under these compounding pressures, honestly, you might want to shred those models right now.
Moving on to Section 3, the Fed leadership discontinuity.
The real crux of the issue lies in the March 2026 CPI data. We have headline CPI sitting at 3.3%, driven massively by that energy pass-through we just talked about, while core CPI is down at 2.6%. That is a full 70 basis point decoupling. Now factor in that Fed Chair Jerome Powell's term expires on May 15th, and the nominated successor is Kevin Warsh. Now Warsh is broadly regarded as much more hawkish on inflation. So he's walking into a structural dilemma. He simply cannot solve supply-side energy inflation with rate hikes, right? But holding rates steady risks letting inflation expectations drift. This discontinuity introduces a massive, unpredictable risk for literally any leveraged deal financing you currently have in the pipeline.
Next up, Section 4, Europe's binary funding cliff.
The situation over there right now is a total paradox. On one hand, you have Ukrainian forces actually making territorial gains, but on the other hand, Hungary is actively blocking a €90 billion EU loan facility. And without this crucial lifeline, Ukraine is projected to completely exhaust its government reserves by May 2026. If you're out there pricing in reconstruction-linked M&A in Eastern Europe based on the assumption of a quick peace, you really need to consider this. During a brief 32-hour Orthodox Easter ceasefire, there were approximately 4,270 combined violations. That kind of volatility renders any sort of durable territorial freeze highly improbable in the near term.
Let's pivot to Section 5, the AI valuation trap.
I really want you to consider this Socratic question posed by the report. Are standard M&A synergy models systematically overvaluing AI transformation deals? You see, M&A models generally assume that if you buy an AI company or integrate new AI tools, those productivity gains are just going to be broadly and evenly distributed across your operations. But the April 2026 data is telling us a completely different story.
According to PwC's latest artificial intelligence performance study, a truly staggering 75% of artificial intelligence's economic gains are not broadly shared at all.
So what does that actually look like? Well, the reality on the ground is a vicious winner-takes-all dynamic. That 75% of economic gains, it's being captured by just the top 20% of companies. The SVELTE report strongly argues that if an acquirer sits outside that top capability quintile, meaning they lack the necessary data infrastructure or AI talent density, then standard synergy models that assume broad AI uplift will actually destroy value. You just cannot price a deal assuming top-tier gains if your organization only has middle-tier capabilities. It doesn't work.
Finally, Section 6, M&A strategy and earnings. What do we do about all this?
Well, here are the concrete steps for recalibrating your models right now. Step 1. You absolutely must model your base case oil price at $95 to $110 per barrel through 2027. Step 2. Aggressively stress test your discounted cash flow risk-free rates. With a hawkish Fed under Warsh on the horizon, you need to be stress testing at 4.5 to 5.0%. And Step 3. Implement a rigorous AI capability scoring matrix during your due diligence process to actually justify any transformation premiums. Stop just assuming magical across-the-board AI uplift.
So what vital risk adjustments are actually required across your portfolios today? Well, if you have deals requiring continued Chinese manufacturing integration, discount them by 20 to 35% in probability-weighted value. Doing AI hyperscaler acquisitions? Add a regulatory contingency of 15 to 25% to account for inevitable antitrust risks down the line. Over in Europe, reprice your defense deals to account for the clear risk to EU institutional cohesion. I mean, Hungary's veto proves collective funding is incredibly fragile. And as for those Ukraine reconstruction models, go ahead and delay your timelines by at least 18 to 24 months.
I'll leave you with this final provocative thought. Take a hard look at your own portfolios. Are your current deal pipelines actually built for the 2026 high-entropy reality we've just mapped out today? Or are you underwriting a world that simply no longer exists? The intelligence is crystal clear. The outliers are defined. Now it's totally up to you to adjust your strategy. Thanks for joining me for this explainer, and I really hope this gives you exactly the structural clarity you need right now.
This video is produced by New Corporate Management Proprietary Limited, NCM, under the Insight Matrix brand. It is provided for educational and informational purposes and does not constitute investment advice, financial product advice, or a recommendation to buy, sell, or hold any security or financial product. The Economic Fragility Index Framework, EFI, is designed to describe systemic constraint conditions using structured methodology applied to publicly available data. Nothing in this video should be construed as a guarantee of future outcomes, a market timing signal, or legal, tax, or accounting advice. All probability estimates are subject to the NCM epistemic warrant audit confidence ceiling and are capped at 75% maximum warranted confidence. You must apply independent professional judgment to any strategic or investment decisions informed by this video. All indices used in this video remain the copyright of NCM.